The U.S. bombs Syria, the Fed throws some bombs of their own, and buyers could be running out of money. We're going to talk about that all as we start the show.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone riding, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go asleep.
Hi, I'm Steve Miller. Call me Slim. And this is the S-Slim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week. And hopefully lots of great ideas and opportunities for you throughout the show. Well, interesting week for sure. The market chopped early in the week with not a whole lot of movement going on, and then everybody was waiting for the Fed minutes on Wednesday, which came out and brought some fireworks. And then Thursday night, we got the news that the U.S. had bombed the Syria base as punishment for using chemical weapons, and that got the markets nervous. They sold down overnight but then recovered. So bigger movement came out of the Fed than really came out of the U.S. bombing Syria. It's typical that traders rally prices into the Fed news, whether it be the policy statement or the Fed minutes. And so they kind of bid it up, and then afterwards there's usually more upside. This time, though, it was really very different. FOMC minutes brought a big reversal in the market. This time, because it was different, it really caught traders, investors by surprise. They discussed things like high equity valuations. Some of them wanted steeper rate hikes, in other words, moving up faster or bigger. And really the big one was the discussion of their balance sheet. Everybody had thought that the Fed, who had to have this massive balance sheet versus historical levels, was going to just let it slowly mature off, and it wouldn't be a big effect in the market. But they discussed it in a much different way, wanting to significantly reduce their balance sheet. $4.5 trillion balance sheet that they built up because of the financial crisis in 2008. The banks were crumbling, falling apart, and they wanted to reflate the banks because so many of them were under massive pressure, having to have takeovers by some banks. Some they couldn't even get buyers for, like Lehman Brothers. And of course, Bear Stearns went for some ridiculously low price, and that caused the Fed to panic. They pushed interest rates down to zero and pushed money into the banks. Their net free reserves just absolutely soared. Of course, all the money pooled in a liquidity trap in the banks, but the money sat there, and with interest rates at 1/4 percentage point, they had to pay the banks like $6.5–7 billion overall because of all of the money that was being held by the banks in their reserves. And now they're talking about raising rates even faster. And if you had the same balance sheet with a normalization, 3 or 3.5% interest rates, according to the Fed funds, then they wouldn't be paying the banks $7 billion on their net free reserves. They would be paying them $100 billion. And of course, then you've got issues with the budget, which the conservatives want to get under control, and some of them even want to balance. So they're worried about the wider deficits. In that case, they're also thinking of the strong employment numbers. So you have interest rates going up based on this, and the potential for having to pay out all that interest rate. The government, the Federal Reserve, is looking at that and saying, well, wow, we better cut back this balance sheet. Of course, when they do that, it's a big drain on the system. So you have this double whammy going on with, well, rates going up and the liquidity being drained out by the Fed selling off their balance sheet. And that is a big issue. The QE, which gave the false sense of economic growth, that brought all the financial engineering with companies buying up their shares like crazy because they could borrow money for so cheap. Now it's reversing it. That's the QT, the quantitative taper, and that's a lot of problem for the market when we look at that as the potential for, well, sucking liquidity out of the whole system. That's what got the markets really nervous, and those were the three big surprises, with the balance sheet reduction a big surprise, and that could be the reason why the market panicked, and I would say that a 30-point decline in the S&P 500 after that news is reality, that there was some nervousness around that. I'm going to talk a little bit more in a moment about another issue that's a big problem for the stock market here going forward. Overall, for the week, the stock market, well, not very big moves. We have the NASDAQ, the S&P 500, just barely to the downside here. Russell a little bit worse, down over 1%, and the Dow Jones Industrial Average Transportation Index right around 0 point for the day, for the week. So pretty even as far as that goes. The bond market up just under a point. Safety bid came into the bonds and gold and the dollar as all of this was going on. So the bond market remained firm, though Friday, when it panicked to the upside, there was a big reversal. The dollar, similarly, a strong week, as well, interest rates going up, they believe, is good for the dollar. I contend that's not true, because historically the dollar moves based on the economic future, and so the dollar may look a little strong now, but I actually think that that's really not going to last very long or go very far. Gold and silver were really strong also. It's unusual for gold to move up when the dollar moves up, but we saw that this week with the safety bid, though gold has completely given it up now here on Friday after being up like $17 or something like that. So it's had a big reversal in there, just as the bonds did. And a lot might have to do with the fact that, well, markets just tend to calm, and it seems like all of this that went on with the Syrian bombing and, Russia, they were notified about it, and they got everybody out of the way, would be what it's my guess, or what it looks like. So maybe the whole thing really was a big show for everybody, and everybody kind of wins. Russia gets to send their warship into the Mediterranean, which they're doing right now. They look strong. President Trump looks strong. Red line crossed and bombed, which is not what we got from the past administration. So that's, the market is kind of settling down here as we're up a little bit for the day, as we're getting ready to move into the final hour for the day as we do this show. So oil market, that moved up. Also, as fear about things going on into Mediterranean really push oil up very often. It looks like to me oil, which had a pretty bad pattern technically going on, may be repairing itself in here. It gains almost 3% on the week. Pretty strong. Gold and silver, like I say, they were strong, but I'm thinking they're going to pull back because it might be just me wishing, because I want to buy the next dip in gold and silver. Let's get back to the stock market right now, as I'm going to show you something in here that I think you're going to find, well, very interesting. There's one site, dshort.com, that I think is phenomenal. Puts out some absolutely great charts in there. And I want to show you a couple slides right now that I think are just unbelievably telling about the condition of the stock market. So I'm going to share a couple of his charts. We're going to look at margin debt versus the S&P 500, and we're going to look at the negative credit balances and compare that to history. And what's interesting about this chart that I'm going to show you is that the look at the margin debt is a little different, because he inverts the chart on this. So essentially, you can see. Well, we'll forget about that because you didn't see that, did you? We have to get that production right, guys. Okay, here we go. Here is the chart right there. And there you can see margin debt. This is the inverted chart. So what you're looking at here, the blue line is the S&P 500 right in here. And you could see that's where it's moved up since 2008. Of course, it traded at 666 and then moved all the way up here to 2400. One, great rally, right? But what I want you to see is the major peaks in 2000 right over here, in 2007 right over here. And note the inverted margin debt. In other words, you could see the mirror image in here as the stock market goes up and margin debt builds. So in other words, the margin debt is going up in here. That's what drives the stock market up. And then as soon as margin debt starts to reduce, then the stock market starts to break. You can see that margin debt got so much worse here in 2007. And this is incredible. Look at this down over here. The margin debt is just absolutely enormous. You can see when it started to reverse here, it brought this 17% correction in the stock market right there. Now, margin debt as of February, I don't have the new numbers, they're not out yet, but this is just a massive record, and that is showing that there are issues here in the market. People are just so incredibly margined. So now look at this chart right in here as we look at the New York Stock Exchange investor credit balances and the market. So in other words, what this shows you is, well, how much money is negative in their account. In other words, how much they've borrowed. You can see right over here in where these peaks were in the 90s. They didn't get very far. In other words, the net investor credit balance to the negative side wasn't very significant. But this 2000 peak right over here, you could see that. This is the 2007 peak, so they dipped deep into the money, but not as bad as 2000. Look what's going on right over here. Now, D Short calls this the tech bubble. Of course, this right over here is the bubble, the real estate and financial bubble. And here's what he calls the Fed bubble right there. And man, is this ever the Fed bubble. The people have dipped into their accounts to massive amounts of money. Where is the money going to come from to fuel this next upside move in the stock market? Well, maybe it won't. Maybe there is no fuel for the next rally in the stock market. And maybe the next rally in the stock market doesn't get very far at all. So pretty key stuff you could see right there. I mean, basically, the money is spent to get the market up here, and once this starts to unravel, well, it's going to unravel in a very big way, and we're going to start to see markets move significantly lower. It might take some testing of the top. It doesn't have to happen tomorrow, but man, there is trouble here, and you could see the money that fuels the rally is already spent. They're deep in the hole. Huge margins, huge negative credit balances in the brokerage accounts. That's what they're talking about there. And that says, well, some trouble in the market. And I would look for the market to begin to struggle in some big way pretty soon. All right, so let's take a look now as we look at what happened to the stock market in this last week. So here is the 60-minute chart of the S&P 500. And you could see that. What happened on Monday? Well, what happened big, if there was any big news, was auto sales just were horrible. Nissan came out and they said that their sales were really poor, and the same thing for Honda. So, that I think weighed on the auto stocks. And that really brought some selling in the market that you can see right over here. So really some significant decline there. But then, of course, the market came back right over here. ISM was weaker, and the bonds did pop in there based on that news. So they recovered, stocks recovered a lot. On Tuesday, we saw the downgrade in Alphabet. I mean, Google moving to the downside, that would be really an unusual thing, right? But that's what happened. And that hurt the stock market over early on, but not all that much. And, of course, the market got a rally back. We actually beat the analyst on Alphabet. We had Google as what we call a negative setup. In other words, a candidate for short sales, and it's been really weak ever since that. So, and this is where they confirm those auto sales down 5.7%. That is a just huge drop, and the autos are really in some trouble when you look at that. Well, used car prices are plunging. Average net equity is at a record low, and the subprime loans are at record highs, and there's a big issue in there because delinquencies are rising and CarMax stock is plunging, and that makes a lot of sense. Comes Wednesday, world stock markets were kind of mixed, but China was really strong up 1.5%. This was the Fed day. Stocks were surging early, as you can see right in here, up some 17 points in the S&P 500, but then the Fed minutes come out and you get the big plunge, 30 points through the close from the high of the day. So it was a ton of weakness in there based on this Fed news that we have already talked about. Panera early in the day helped push the market up. It soars 13%. A $5.7 billion buyout with insane valuations. JAB buys that stock, and I don't get how they think they're going to get their money back on that one, but crazy stuff. Gold and the bond market drop and then pop on the news of the FOMC minutes, and you can see that right in here. Wednesday, the stock market throughout the world was mixed. U.S. stocks tried to rebound and ended up to be just choppy in here. The jobless claims, now this is significant because that's part of what the Fed is looking at in here and why they're thinking a lot more hawkishly, as 234,000 jobless claims was an extraordinarily low number. We're really getting to some low numbers in here, and that's just showing that the job market is strong, and there's a fear of wage inflation coming in, and they're trying to get ahead of that right now. Friday, we had the news overnight that the U.S. bombed Syria. You could see what happened. We got a big down move in here in the S&P 500, some 15 points. It fell quickly, and then ever since it's been edging up right through the overnight session and through into here as we get into the last hour on Friday. So oil pops $1 and then gives most of it up. Gold market, silver market, bonds, they all had strong bids and they gave it up also. So no panic in the markets right now at all. And, we were really looking for our short-term view down through Wednesday and then rally back. And we pretty much got what we were looking for. In fact, when we do our short-term view, we'll show you that for the stock market that we have pretty much nailed what we thought would happen for the week. Maybe some of the other markets weren't all that good. Take a look here as we look at our calendar for the coming week, and you can see that there is, not all that much going on, as we have the coming earnings cycle right ahead of us. And that gives you usually Alcoa, but they've changed when they report, so they're no longer the first one. And what we're going to really get is, this on Thursday in the morning, we get 4 of the banks that start reporting. That's the beginning of the bigger earnings cycle, and it'll still take another week or so before we get into the real crazy, everyday, huge amount of reports. As far as the economic events go, there's no giant market mover in here. This one right over here, the Consumer Price Index on Friday, could be one that gets the bond market moving. But other than that, there I would call nothing just really overly significant as far as the markets go. So that is a look at the economic calendar and earning reports for the coming week. That's the end of the opening segment. Hope you love that. I did. And now we're going to get into the best and worst stocks for the week. All right, for the best stocks of the week, there isn't all that much to show you, actually. I'm going to look here at about 5 or 6 of them. Here we have the biggest mover. This is now going to come out of our major list, we call our Group Universe list of 325 widely held stocks. This one gets bought out by JAB, an incredible 19% gain on the week. A roughly $15 share on the price of the buyout. Just an extraordinarily high valuation. I don't know what they're thinking. You can see in here our analysis essentially had the bottom pretty much pegged right in there. And these up weeks, well, they made a little bit of sense, but this makes, well, no sense to me. Stock is going to get gone, and that's the end of Panera as far as me watching it. Staples, well, it's like this is a week of buyouts and wannabe buyouts. Staples is exploring putting themselves up for sale. You can see the inverted head and shoulders in here as it formed perfectly. If you ever wonder why inverted head and shoulders form, well, I have a video on that if you go into my video library, and here you can see the left shoulder right here, the right shoulder, the head right there, the upward slanting neckline, which it hasn't broken out of yet, of course, and the cycle lows right in here as they were absolutely perfectly right on. You can see that as the cycle rhythms pretty much have this one nailed. 2 weeks into this advance right in here, it's not likely it's going to end that fast. This stock is not, in my opinion, very worth getting sold, but while they're sniffing it out, the stock will probably move to the upside some more. Golds were strong also this week as gold moved to the upside. So there's gold, GOLD. This is up 8% on the week. Now, this is Rand Gold, and you can see in here that this kind of says that maybe there's another 2, 3, or 4 weeks of potential pullback in there. That's kind of what we think is going to happen in gold. So this up 8% on the week, a good week, but I have some doubts it's going to be able to continue. The big winner for the week was AU, and we have the same pattern going on in here where we think it's going to pull back one more time. Like I said, maybe I'm just hoping in there because I want so badly to buy that pullback because I think it's going to be a great opportunity. Newmont kind of a laggard, up 3.5% on the week, and you could see the same pattern in there forming where we think that it's got a couple 3 weeks left in here. It's going to probably hold the support zone and then turn to the upside. So see, it's stuck right in between that resistance and that support zone right there as it shows up in our weekly stock patterns there. And of course, our chart subscribers get all of that every single week from us. Tesla gets a good upside move in here, and I'm working on a report on Tesla that I'll bring out in the next couple weeks. I think it's very interesting, and the very basis of it is that, well, all these Model 3 buyers, well, they're not all going to get this government incentive. As a matter of fact, government incentives can run out a lot faster, and I've been reading some very important studies in there, and you could see our projection in here, right? I think the stock in the next month is going to fall to 275. So, I mean, for short term, I'm giving it a downgrade right now, and yes, I shorted the stock today. So I think that one is going to move to the downside one time, and I think a major top is going to form in here in Tesla, as you could see how we have this projected. And Whole Foods, WFM, that moves up this week. Also, that's not WFM. Let's get WFM up there. That stock moves up nicely. Now, what's interesting about this one is that analysts are cautious on this one. As a matter of fact, UBS says sell, but our cyclical patterns in here are positive. What makes them positive? Well, take a look right over here, and you will see that this is what we call a base being built. You can see the low do right about over here. So here's the cycle rhythms right in here. You can see that. There's the low right there, the rally, and the low right in here. And then the smaller patterns you can see right in here. Pretty clear when you look at that. And there's the low do right here and the move up here. Question is, will it be able to break out, or is this just going to be a fake out? In other words, it would get up to maybe this area up here, $35. We'll say that's right about in that area. Maybe it stalls right over here at the $33 and then gives you another one of these patterns over here. But for right now, this pattern looks pretty good, and if it pulled back, I would buy it. So that I know that's not a great looking stock when you see 2 years and a half of just chopping between $27 and $34, but now it looks like it's probably going to head towards the top of that range, and that is the best of the week. Not a whole lot to report there, is there? Well, let's take a look at the worst. There's more. All right, for the worst of the week, we have a number of stocks to look at and here that move down. The teen retailers set the trend in here for retail, which had a bad week. Of course, the brick and mortar retail is just melting, and that is maybe being exacerbated now by reports of huge retail layoffs about to occur in the industry. And these patterns, some of them tried to bounce, but now they are looking just absolutely sick. As a matter of fact, ANF, which I'm going to show you first, down 11% on the week, has been in a massive free fall from $32 down to $10, and now the pattern making a new low right now for the last year, and at this point really in a very negative pattern. So when we look at these patterns, one of the key things for me to look at is when you get a breakdown under a key cyclical level. So there was one right over here, and when that occurred, it sold down all the way down to this cycle bottom that we expected. As a matter of fact, you could see the same thing right in here. It sold down to the cycle bottom here, though it bottomed a little bit early, and now this has the breakdown here, and this points to June or July before it can find a bottom. This will be a single digit stock, and that is really an incredibly ugly pattern. So retail in just huge trouble. Sketcher, SKX, this one doesn't really give us all that much in cyclical rhythms. We don't look at it that much. But what we see in here looks kind of clear to us. So note the bottom right in here, that's this decline and this rally. Note the bottom right in here, and that's this decline and this rally. So when you get a sign that it's rolling over right in here, then you go down, through the next declining period, which is in May. So we think this one has rolled over already. Take a look at this. This is a classic bear kicker on the daily chart, and now we see the momentum turning negative, breaking underneath this 89-day moving average. That is a bad pattern in Skechers, down 11% on the week also. Take a look at Deckers, DECK. This stock giving a sell warning in here. This is known as a dark cloud cover. So it makes a new high, the body makes a new high, and then it comes down most of the way. In other words, more than half of the way. And that sets a top. If you want to see how that's worked in the past, this was an engulfing. In other words, it made it just below that number, and yes, a collapse after that. This one didn't give you a great signal in there via the candlesticks, but here's another one right over here, and you could see the big move down. So we think that on the weekly is giving a pretty bad sign. Now, when you look on the daily, and you see this big island reversal pattern right in here, so there's a gap up and a gap down. It leaves the island. That is a bad pattern. Also, so Skechers looking to us like, Decker's looking to us like lots of problems in there. Other stocks in the retail category, JCPenney down 6%. You know how I feel about that one. Urban Outfitters down 6%, and Nordstrom's and American Eagle Outfitter and Coach all down 4%. All of those stocks have immense risk. I wonder when Tiffany is going to get caught up in this, and it can't be all that far away. Also, hasn't really shown up yet as very negative, but I think that's coming also. I mentioned the problems in cars pretty much before, and of course, BorgWarner, BWA, is getting caught up in that. And this is a really, powerful industrial company that has had just surprising problems in here. It's been in a rally, but not very far compared to having been at 62 and then falling all the way to 27 last June. And now having put on a pretty good rally, but this is not a good sign. 9% down and getting really caught in this downswell of the prospects for the automobile industry. And so here's the cyclical rhythms, and here you could see very clearly as this kind of made a base and that allowed it to get into a rally. This was a positive cycle. This was a positive cycle. Now it comes down to the 34-week moving average where it got support. So this downward trend in here is pretty bad. It's right on time, and we think we're going to get a feeble rally in here. As we look at the daily chart in here, you will see that the momentum, that's the red arrow here, turned negative, and that happened on the 24th of March. And then tried a little rally, got up to the slim ribbon, and then accelerated on the downside, you can see in here. So this negative momentum has really grabbed a hold. And, that area of the 89-day moving average, we think it could bounce back to. That's about 40. So you can see we have the side-by-side charts right in here, the weekly here and the daily here. So this move up to 40, potentially right here, is what we have drawn right over here. And then we think it gets absolutely cremated again. We could see the stock getting back under $30 really because of the malaise that we're seeing in the auto industry. While we're here, why don't we just look at CarMax, since we're talking about autos, down 3.5% on the week. You could see the timing is almost exactly the same as BorgWarner's. As you have this kind of wedge pattern going up right over here, you could see that, and here's your lows right over here. It's under the 34-week moving average. It seems to do that. You can see we're going to look for a bounce maybe to 59 in this stock, maybe $3, but then I think it's just annihilation after that. So CarMax down about 3.5% on the week, and some pretty good trouble, as you could see in there, as those are not looking very good. I would say they're in major declines when we look at BorgWarner, we look at CarMax. Talk about major decline. This actually might be happening to NVIDIA. This was one of the big movers, and now it's making a double top or head and shoulders top in here on the weekly that is really giving some sense that there could be trouble in here. Let's get a little closer look right in here. You can see this double top that occurred. Now, what's key in here, and remember, I'm a cycle analyst. What I look for is the rhythms in the stock. That's the money flow. Note the Harami cross right over here made the top. We noted that when we saw it back about 2 months ago. Saw the double top forming in here. It had to decline into the nested bottom, as we call it, 2 cycles, and then the advance, but then you see it come down like this. Goldman Sachs sees another 20% downside risk in this stock. That would take it to 80. We could see that happening in here, getting into the 80s. There's some support right around this area at about 88. So that's the way we have it projected. It didn't break down, but if you see it under 95, you're going to know that it's really massive trouble in here. You can see in here the analyst downgrade as it broke underneath the support of the 89-day moving average, and now we have this red bars and in here which are saying that the momentum has turned negative. I think if you get a bounce to 102, 103, you just got to lay on it and short it, because I think it's not only one of the worst stocks of the week, but one of the worst stocks I see with potential strong downside in there. And one more stock we're going to look at in here, which is the DPZ, which is Domino's. Domino's is on my list of the riskiest stocks for 2017, and it's done well to this point. I actually think that there's some pretty good risk in here, as maybe we have another 2-3 weeks on the downside risk right now. Then I think you get a feeble rally, and I think this stock is going to be finished. I think a major top is forming in Domino's. The point that I made when I originally looked at it was the PE was just extraordinary, and it even went up. These were PEs towards the end of the year, so they're a little higher than that, and you can look at the rest of the industry. Well, Panera, that one got bought out at about a 33 PE, so that one I think is just nutty, but the rest of the industry PEs are lower. And if the consumer is running into trouble with like the trouble in automobiles, then you've got to say that there actually might be some pretty good trouble coming on for the restaurants too, because it makes sense that there is some alignment with that. So that is a look at some of the really bad stocks for the week. And right now I'm going to talk to you about something special, and then we'll get to the short-term view for the week. All right, so I want to talk to you for just a couple of minutes about our memberships. It's really important that you listen to this, because I think there's great information for you. And of course, the more subscribers we have, the more we can expand the content that we bring, which I think is already, just amazing. So I want to show you our level 3 content. We call level 3 our raise. Level 4 is all in, of course. So I want to talk about our level 3 content. I want to take you to the Ask Slim website really quickly here, and just walk you through this for about 2 minutes. So stay with me, and I think you'll find something really interesting. Here is the Ask Slim website. Of course, that's our front page. And here is our player that shows up right there. And there's a couple things that I want to point you to. First of all, we do what we call is our rankings and trade setups. That's our level 3. And what we do is, for our trade setups, is we share our analysis and let our subscribers know when we think there is a setup that can give you a favorable entry. It's really important to get favorable entries. Well, why is that so important? Because, well, if you do, then there's less risk of getting stopped out on a trade and losing more money. And of course, it's the issue about psychological triggers. In other words, when things start to go wrong, especially a string of things go wrong and you get into a slump, it's often because of poor entry. So what we really focus on is sharing our analysis so that you can get a better entry. So here's our rankings and setup. We call this our marquee, and you can see our trade setup. So far, we've had 369 in just over the last year. We rank them by the reasonable opportunity for profitability, and 62% of those have had very reasonable opportunities for profitability. 28% approximately of them have not worked. So that's about 2.5 to 1. I don't know where you're going to get that kind of real good information on setups. In other words, when things are offering an advantageous entry. And we always say what our last 15 has been, and it's been 11 positive and 4 negative. So of the last 15, 11 gave very good possibility for profitability. And our subscribers really have enjoyed that. I want to show you just really quickly what the level 3 information looks like. If I go to the dashboard up on the top right and click on that, it's going to take you to the dashboard. Now, this is a dashboard for level 4, because that's what I am, of course. But level 3 offers all of our videos. You can see our 8 different video categories in here, plus rankings and setups. And I'm going to click on the rankings and setups right there. And when I do that, it's going to bring you to the rankings and setup page. And this is the rankings and setup page. And you could see right over here all the information. And then this is what you actually get. We rank in 4 different ways. And that's a long-term ranking, an intermediate-term ranking, a short-term ranking for the 81 best traded symbols and optionable symbols that there are. This is going to cover everything that active traders really need to trade, and it's amazing information. So you can see in here, here's Caterpillar, which has all 3 positive, long-term, intermediate, and short-term. Generally, for investors, we suggest you use the long-term and intermediate term, and for shorter-term traders, the intermediate and short-term. We also offer our option bias ranking, which essentially gives you a sense for direction for your option positions. And those biases have just been fantastic. And what's really great is when you get an orange reading that is a pending for reversal. So, and those are running about 68% as reversals coming with just a matter of a few days. So that's really been fantastic. So when you see all or something is red, you'll notice here Google is N3 red, and it does not have, the long term is still good, but the intermediate and short term are neutral in there right now. So that is setting up what is, what we consider to be a negative condition for option traders in Google. So amazing. Then we put our trade setups in, and when after a trade setup is no longer available, we gray it out, as you see right in there, and the ones that are still open we leave right here. And then we do what's called our trade selections. So in other words, we put up trade selections. All I do is click on that, and the window opens up to show you, in this case we had put in a copper setup, which was a long copper setup, so we believe that it was moving up, getting ready to move up, and we put in the price and the favorable range that we believe that the entry will come. And then we don't have any option, a model for options in here because there's really not much to trade in copper. But what we do is put in a model for stock replacement or call spread or put spread for directional trades. So that is a look at the just fantastic level 3 membership. You get all of our rankings that you saw right there with the option rankings, which are so good, our trade setups, which are just doing really fantastic. And you can have that and all of our videos in a trial. How about that? Over 200 videos. It's so much for you to learn there. For half price to try everything there for 1 month, $43. All you have to do is write me, slim@slim.com. Tell me you want that link, and I'll send it to you, and you could just look at all of the stuff for the next month, and I think you will find it incredibly valuable. So that's the piece I wanted to share with you. Please do become an Ask Slim member, level 3 member, and give that a try. And here comes the short-term view. All right, we're back for the short-term view. We are going to look here at the S&P 500. We always take an accountability what we thought was going to happen in the last week. Last week we thought that the stock market would dip into midweek and then rally back. That's pretty much what we got. Our target for the downside was 23.52 down to 23.46, and then we thought it would rebound from there. And that was pretty much a bullseye. So we're going to take a look at that and also look at what we think is going to happen in the next week. Take a look right over here and you will see the daily chart that we're looking at. And there is just remarkable cyclical action in there. The bottom in here are our cycle patterns. These are the cycle brackets, and we use those as guides to help us. So this cycle bracket has a setting on it of 19 days. So that tells us that this 19-day, that was an 18-day low, a 19-day low, a 20-day low, that was a 17-day low, and a 20-day low. And that's this rhythm in the market that you can see. And then we look at the smaller ones to help us understand the bigger ones. That's analysis with multiple time frames. So here's where we are right now. We thought that the market would dip down between down to as low as 23.46. It actually got just below the 23.50 area right there. Now that low right over there is very key, and I'll tell you why. So these are generally about 9 to 10 day patterns in here. So what you can see in there is that if you count these days, this day right over here was a 9th day low. So this is 10 days off that low. If it happens to be that it rallies and then breaks that important low, it's going to set up a trend more negative than even I have this projected. So that would be something like rally a couple days, hit the minor resistance, come down and break this and fall hard. I actually don't have it as that negative when I look at this. I'm going to call for a choppy up week and then fail into the following week. That would be getting into this minor resistance zone, not really giving up all that much time. 23.67 approximately is the target, and then fail. And then I would say that could set up a little better period after that. But overall, I think it's going to have some problems in here as both of these patterns then turn over. So we're going to call this coming week kind of choppy, trying to make some upside, and then rolling over, and that key number right over here of support at around 23.49, that's only 10 points. If that gets broken, let that be your warning in there that something much more negative is going on. So that is a look at the short-term view, and I would expect that there is more potential weakness at the moment for the next week or week and a half than there is upside potential based on what I'm seeing in this pattern, that big engulfing pattern that we had occur in so many stocks. So many stocks gave sell signals, and I did a video on that Thursday for my members if you want to go look at that. So many stocks had sell signals that it says to me that upside progress is going to be tough. And I gave you in the beginning of the show other reasons why I thought upside progress was going to be tough, and that's the condition that I think the market is in. Hope you love the whole show, and I want you to be very careful, man, because it is crazy out there. I'll see you next week, and I'm always wishing you great trading.
Well, I'm going to